as a
Yeah,
high net worth investor, you're going to get a lot of people calling on you, right? And you got to be
sure.
careful about who you choose to
To
work with
sell, they're
and find
wanting to sell their residential or their commercial portfolio, but then what are they going to do with those proceeds, right? Because when
right.
you
Yeah.
sell that income producing property, you're going to lose that income. Well,
I really want some big returns to get up to 4 million, but how am I going to get my
right.
2 million back? What
Yeah,
should I be
sure.
asking you? What should I be looking for? All right. Well, Tom, thank you for coming on the show today. Why don't you give us a little bit of your background?
Sure, Joe. I appreciate the invite. It's great being with you and all the listeners today.
You bet.
I'm uh, I'm 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 solidly in my 50s now, so that's a dangerous question to ask me because I could go on and on, but I'll give you the short answer.
Yeah.
So I came out of business school. I was a corporate finance and mergers and acquisitions guy in the aerospace industry, software, telecommunications. So really learned about deals and how to get them funded, the debt and the equity. So had a great foundation set there, but I really wanted to go out and do my own thing. And that was kind of forced upon me when I was fired for my corporate job in 2006. So I went out to took that opportunity to go out and start to build my real estate empire.
Mm-hmm.
And of course, 2006 probably wasn't a great time to start doing that because, especially because I didn't have any experience in real estate at that point. So I proceeded to get my butt whooped pretty good those next few years. But along the way, learned a lot and persisted and reinvented myself from a kind of a residential fix and flip guy into a distressed mortgage debt investor. So we started a company, my partner Joe Downs and we connected in 2010. So that business, U.S. mortgage resolution, still rocking and rolling today, pretty good. We've generated over $54 million of revenue in that business over the years, which has allowed us to do some other things. So we've looked at hard money lending, we've looked in title, we've done some other things in and around real estate. We've participated as LPs, as passive investors in some apartment deals. But we found self-storage in about the 2017, 2018 timeframe.
Okay.
2019, we joined a mastermind. We were going to all the conferences. We put a team together. And then 2020, we acquired our first self-storage facility. And now we've acquired 14 facilities worth over about $41 million. And so we're just really excited about the team that we've built and the market that we're in. And so we got some solid growth goals going forward. So that's about as short as I can give my background, Joe. I hope that was
I
okay.
appreciate it. I appreciate the where are you guys focused for your acquisitions? All around the eastern United States?
Yeah, primarily East Coast. We do have a special scenario right now where a friend of ours that we've known about 5 years through our self-storage mastermind community, which is that's a nationwide community. He brought a deal to us out in Minnesota, but up until then, we've been up and down the East Coast from New York State down to Florida.
Okay. All right, very good. Well, we know you've got the background, but today we're going to be talking about pitfalls for high net worth investors and how to avoid them. So now, how did you get involved with working with high net worth individuals? Excuse me.
Sure. Well, as I mentioned, when I got booted out of corporate America 2006. I guess the good news was at that point, I was a vice president at a publicly traded company. So when I left, I had a nice war chest of capital to go and build my real estate empire. Of course, I lost it all over those next few years, but I've been a high net worth investor myself for
Okay.
going on 18 years now. And so I've made plenty of mistakes, but I've also done some good stuff, and I've learned a lot. And so as we're out looking at deals, I'm looking at them as an investor because we invest in all of our deals ourselves. And so when we had those experiences and those successes and failures along the way, we found that it really kind of boiled down to a few key areas. And so
Mhm.
what we do now is we're building our list of investors and trying to educate and nurture the folks that invest with us. Is we give them that framework and we try to teach and let them know like what our experience has been there.
Okay. Now, as far as the pitfalls, what's the most common pitfall you see that a high net worth client is making? I mean, I know out here in LA, we deal with a lot of high net worth clients, and sometimes I'm like, okay, I didn't see that one coming. But what are you seeing on your end as far as a major pitfall?
Sure. Yeah. I think one of the big things, Joe, is investors. When they're excited about a deal or they're, they really like self-storage and they're dying to get into a self-storage deal,
Mhm.
so they start looking at the deal right away. They look at the property and the projections and the numbers and how much money can I make and this and that. I think that's the wrong approach. I think the first thing you need to do is start with the sponsor. So you need to, if you're looking at doing a deal with us, you need to be looking at me and my team and asking us hard questions and doing your own third party due diligence. Google my name, Google Belrose Storage Group,
Mhm.
see what you can find about us so that you can learn about us and our track record, so that when that deal is presented to you, you have at least some context and some confidence in where those numbers came from. And Joe, the way I learned this lesson, I will share with everyone. I actually lost $50,000 because I invested with a guy who was just a full-on criminal. And had I just Googled his name, I would have found all this bad stuff that had happened. But he gave a great sales pitch. The deal sounded great. I was like, okay, let's do this. And then, next thing I know, he's in prison and my money's gone. So
I'm sorry to hear
now,
that.
in my own defense, I do have to defend myself a little bit. This was back, before, everything lived on Google, right? So,
Right.
Googling wasn't really a thing back then, but it did exist. And had I done it, would have saved me many, many dollars.
Yeah. Yes. We sold a property, and for our regular viewers, they're going to hear me. I've told this story a few times that we had some multifamily properties around Texas, and this guy came in and wanted to buy the entire portfolio, and it wasn't on the market.
Hmm.
And so he goes, "Well, what do you want for it?" So we put a number in front of him. He goes, "Okay." And once we were like out of shock, we're like, "All right, well." He took it, and he bought the entire portfolio. It wasn't a big portfolio, but we found out later that he was not only the syndicator, but he's also the contractor to do all the work, and it needed a lot of work. So as
Hmm.
he uploaded or front loaded all of his fees, he didn't care if that thing made money.
Oh,
And there's
man.
a lot of people got hurt in that. And so that's what I
Yeah.
think, we see that people have done deals before. We got to really, you want to do your due diligence ahead of time. But now, do you have people that
Yeah.
reach out to you and just, want to have a conversation with you before investing and say, listen, I want some references?
Yeah, Joe, I do get that question. I wish I got it more, to be honest, because that
Yeah.
tells me that the investor is really taking a good look at me. So yeah,
Mhm.
for sure, we have a list of strong references that we provide to folks that ask for them. And like I said, I wish more of our investors or potential investors would ask, because they'll hear the straight scoop from somebody else, not just from me.
Yeah. Yeah. That's the thing is, as we were talking before we started shooting, is, we work with several high net worth clients here in LA. And, not many family offices, but mostly just the individuals themselves. And before us getting involved, they were making decisions on referrals from friends. And I'm like, well, you're at a whole different level. This one client is a multi-billionaire. So you're a whole different level of fish than this guy. And so
Hmm.
you need to
Yeah.
really check yourself, make sure this is going to be right. And when we started talking to him, digging into his past, he's been taken several times. And so you really want to make sure you're doing your references and checking them. Do you guys do mostly family offices, or do you guys do mostly private investors, or
Yeah,
both?
we're at this point we're mostly just private investors, folks that can write a check for 100 grand, 200 grand to participate in our syndication. So they're accredited investors.
Okay. All right. Now, are most of your investors in this to make more money, or is it for wealth preservation at this point?
Yeah, that's a great question. We're advising our clients, our investor base, that capital preservation is really important right now. We've just come out of all this roaring inflation and rates going up, and all kinds of volatility, and now we've got some wars breaking out here and there. So where we are in the world right now, and with the uncertainty of the economy going forward from here, we're really preaching to our people about, hey, let's take a good hard look at capital preservation here.
Mhm.
And let's not tie up your money and sit it in a bank somewhere. You got to keep it working for you. I know sometimes it can be a little scary, but it's better to invest it in a hard asset like something related to real estate that's going to have some cash flow associated with it and some tax benefits. It's a much better scenario. And I guess the other thing too, Joe, is we want our investors to get that cash flow and then experience some growth later on. But right now we're prioritizing, kind of capital preservation first, and then cash flow, and then growth.
Yeah, that's what we're seeing as well. Your most of your investments that you guys are doing with high net worth people, are they concerned more about cash flow or appreciation? Probably just cash flow, right?
Yeah, it varies, and that's one thing we've done recently in our capital structure is we've created now two classes of shares. We used to just offer one class of share, but as the economy was evolving, and we got some feedback from our investors, we decided to split it into two. So we have Class A, which is our priority preferred equity investors. They get a steadier cash flow. And so they're more cash flow oriented. They're less interested in kind of that back end kicker. Whereas the Class B is less cash flow up front, maybe a little bit more cash flow later, and definitely a bigger part of the profit split later. So those are we've geared that for more growth oriented investors.
Okay. Now your investor profile, what do they typically, now this might be confidential. I don't know if it is, just say I'm not talking about it, but what's your investor profile look like typically?
Yeah, sure. No, that's a fair question. I mean, the reality is, Joe, I mean, our investors span, all different, kind of shapes and sizes right now. But as far as who we target, like when we're going out and we're trying to attract new investors, we're looking for landlords who are maybe tired of running their residential portfolio or maybe their commercial portfolio. They're getting to the point in their career where, hey, they're looking to maybe get on with the next chapter of their lives and actually get to financial freedom and that sort of thing. Maybe the kids are older, out of the house, that kind of thing, and they're starting to sell. They're wanting to sell their residential or their commercial portfolio, but then what are they going to do with those proceeds, right? Because when
Right.
you sell that income producing property, you're going to lose that income. Well, here at Belrose Storage Group, we'd be glad to take those dollars on. We
Right.
can generate income for you passively so that you can go experience that freedom that you've been looking for a while. And we can also provide you with the tax benefits and future growth potential as well. So we're looking for those. That's kind of our ideal kind of investor.
Okay. Now I'm running into some investors that are dealing with high net worth people, and the high net worth people are calling saying, listen, I need cash. You need to sell. And so I don't know if that's something you're experiencing, but you know, they had a lot of office in their portfolio. They weren't very diversified. And that's something I see across several high net worth investors is that they're not very diversified. And probably should be. It's a little bit of office, a little bit of multifamily, self storage, always solid, industrial if you can get your hands on it. Do you look for what do you look for in your high net worth investors as far as their diversification of their portfolio?
Yeah, sure. We're always pushing for diversification. I mean, even though we're a self-storage shop,
Sure.
at the end of the day, I'm an investor myself. So, I love self-storage. I think it's a great asset class. But as I mentioned in the intro, I also invest passively in multifamily. I also do some private lending, both in my regular taxable accounts and also through my self-directed IRA. So that's kind of what I preach to our list of investors is, hey, let's do some storage stuff, but hey, there's also these opportunities for private lending and multifamily, and like you mentioned, industrial is great if you can get in there. So
That
yeah,
phone's ringing constantly on that one.
yeah, right.
Yeah.
But I think that's the great thing about real estate, right, Joe? I mean, you can diversify across asset classes, geographies, sizes. Whereas their typical financial advisor is going to tell them that diversification is large cap, mid cap, and small cap. It's like, come
Mhm.
on, man, that's not real
Yeah.
diversification.
Yeah. Yeah. We've got a couple of big office investors here. And fortunately, they own multifamily and industrial around the country.
Hmm.
So the multifamily and the industrial is covering for the office. And so, but we've seen a little tick up in office. So
Hmm.
that's good. But if it wasn't for that diversification, and we see a good number of high net worth people that just aren't diversified enough, and it's creating a problem for them. And they're
Yeah.
calling their sponsors, go, hey, I need money, I need you to sell, and the sponsor just doesn't. They're going to lose so much money they can't do it. So
Right.
diversification is very important.
It is. I mean, you can almost create your own fund, right? So,
Mhm.
we're syndicators, right? So we're fans of syndication because that allows our investors to select which deals that we present them line up best with their goals, and they can, in essence, create their own fund by doing some storage with us, some multifamily with some other people, some lending, some industrial, some office, and so they can kind of create their own fund as opposed to just going into some large you know,
Yeah.
uh, real estate fund where you're not really sure where your dollars are going to be invested.
Yeah. Well, I think it's important, as we were talking before, is, you've got to surround yourself with the right people to advise you, because, you get guys
Mhm.
like you that are out there doing it. You won't take people's money, but like the guy that we sold our portfolio in Texas, I mean, he was brought to us from another broker that had no idea, just want to get the deal done, right?
Mhm.
You've got to be wary of these kind of people. I mean, and
That's right.
I've talked to a few people here in LA that were clients, and I've got one guy that has a ton of money, I mean billions, and he's running it through his ex-wife's brother, and
Right.
not very sophisticated, but very honest.
Yep.
Unfortunately, he goes out and finds the deals. But I spent more time with this guy, the investor, getting him out of deals that he had that were friends that were
Mm.
just completely taking advantage of it. They were
Yep.
making money, he wasn't. And so I kind of had to be the bad guy. And he's just a super nice guy. He didn't want to be, go in and say, hey, I need my money back. But we went in and transferred, and he ended up getting some of the assets himself, just for all the money he's put in. But I think, as a
Yep.
high net worth investor, you're going to get a lot of people calling on you, right? And you got to be
Sure.
careful about who you choose to work with, and finding somebody that's running a fund or somebody like what you guys are doing. Uh,
Mhm.
it helps. It really helps.
For sure. Yeah. Yeah. We have a whole framework that we teach our investors about in terms of how to look at deals, and we touched on it a little bit, but we call it the safe investing method. It's SAFE is the acronym. S is for sponsor, right? You got to check out your sponsor, like we talked about before. A is for asset. What is it that you're investing in? Do you understand it? What's the market like? How does it increase or decrease in value? Those kinds of things. Then F is for financials, which is like the projections and the tax implications and those kinds of things. And then E is for exit, right? So how do you get out of this thing? What's the time horizon, right? You can't, for syndications and most real estate deals, you can't just go to Schwab.com and click, click, click and sell your
Right.
position in a Belrose Storage Group deal. You have to understand going in that your money's going to be tied up for a period of time. So we have a whole ebook on that whole topic. If anyone is out there interested, I'd be glad to get you a copy.
Yeah, I'll put it. Well, they can go in the comments and make a comment, and I'll ping you, and we'll get it sent to them.
Perfect.
Now we're going through some interesting times with interest rates right now.
Mhm.
Mixed news every day, right? You never know who's winning.
Yeah.
But I didn't even look this morning to see what was going on, but probably hopefully it's a
Yeah.
little better than yesterday. But now, how are you guys? You're out there? Are you able to refinance your stuff right now, or you need to at this
Yeah,
point?
thankfully, Joe, we're in a position where we're not needing to refinance. A lot of our properties were acquired within the past couple years, and they typically have
Mhm.
5-year terms or longer. And all but a couple of them are fixed rate. So we haven't really
Mm,
been impacted too much at the facility level by the run up in interest rates.
right.
It's mostly been those other external ripple effects that have hampered not only our self-storage portfolio, but self-storage across the country. But, I think we're really kind of where, rates should be, right? I remember, when I bought my first house in 2000, my rate was 7 point something. And, that's about where we are now. So I feel like people, because we've been in that low interest rate environment for so long, people got used to it and they think that we're going to be heading back there. And I just really don't think so. I think
Mhm.
we need to come around to the fact that, we're going to be in the sixes and sevens for commercial real estate for a while. And I think the Fed just came out just this week saying, yeah, we mentioned something about cutting interest rates, but yeah, we're not going to be doing that. And
Yeah.
the reason is, there's still a lot of fervor in the economy right now. Wages are being pushed up, and there's still a lot of inflation in different sectors. And
Mhm.
so the Fed, they can't really start, retreating on interest rates just yet, if at all. So
Yeah.
that's what we're planning for anyway. We're planning for higher for longer.
Well, I think that, we were so low for so long that people really started believing that it was going to stay that low.
That's right.
And I had investors. I was like, listen, if rates go up, this isn't going to work. And they go,
Hmm.
I mean, these were experienced investors. When I say experienced, they've been in the business about 5 years, but
Sure.
and they had a few $1 million worth of assets, but
Hmm.
they just didn't believe that rates were going to go up. And you've got to look at the real data, historical data, and really weigh it out, because there's a lot of sophisticated high net worth people. They were they locked those loans in. They locked those loans in. They've got cash sitting and waiting to buy right now. I
Hmm.
mean, I'm sure you guys are out. Are you guys seeing in self storage any distressed assets coming on?
Uh, we're starting to see a little bit of that, but
Yeah.
self-storage, that's one of the things we really like about this asset class, Joe, is that the our operating expenses are generally really low, right? So it doesn't take a whole heck of a lot to run a self-storage facility, right? I mean, it's metal boxes, with concrete floors and roll-up doors. So yeah, there's not a whole lot of infrastructure and expense associated with it. So at a self-storage facility, $100 a rent comes in, and our taxes, insurance, utilities, et cetera, only add up to about $35, which leaves $65 to pay our debt and our investors. I'm like I said, I'm a big fan of multifamily. I'm an investor in multifamily, but it's the opposite. $100 of rent comes into a multifamily property, about $70 goes to cover those operating expenses, and leaving only 30 to pay the loan and leave something for the investors. So there's typically been very, very low default rates in self-storage. So I'm sure there's going to be some out there because we went through such an extreme
Yeah.
shift in rates, and I'm sure there's going to be some problem facilities, but it'll probably be less so than other asset classes.
How was the insurance? Now, I'm really sitting here in the middle of a thunderstorm in Southern California, so you know what's going to happen about insurance, right? There's going to be a lot more news coming out because those rates are going to go up even higher. But is that
Right.
affecting you guys much right now?
It is, yeah. So property taxes, insurance, are going up, and of course we have little to no control over that.
Right.
We have some properties in Florida, and we've run them through our value add strategy, and there's not a whole lot of juice left to squeeze there as far as improving the operations. But we're having trouble, getting those out to market at a number that works for us, because there are buyers out there that are just flat out saying, "No, we are not going into Florida because the insurance rates are so high." So we're looking at some creative solutions there, but have to stay tuned on that.
Yeah, we all are. I just think Southern California, we've had so many insurance companies packed up and left.
Hmm.
It's going to be because there's a lot of damage. I just was told this morning Topanga and Malibu are closed. So
Oh,
there's a
wow.
lot of roads are down. So there's going to be and boulders have come down on the roads, and cars have been washed off
Oh,
the streets.
awful.
So a lot. But, when we talk to some of the high net worth investors, that's one of the things now that you're hearing from them is, let's get an insurance quote on this prior to even, they're looking at that first too. That
Sure.
just started in the last year or so. That wasn't before.
Yeah, it's crazy.
Mhm.
We're one of the creative things we're looking at is, well, we're trying to find out if insurance policies are assumable. So like if we bought a facility, maybe the prior owners owned it, since, or their last insurance renewal was a couple years ago, maybe, we're wondering about, can we assume those? So we're looking into that. We're also looking into captives, and I don't want to go off like in a whole rabbit hole here, but a captive is basically a way for a group of property owners to get together and self-insure, kind of each other's properties, and then you have some reinsurance behind that. So we're looking at all kinds of different ways to skin this cat, because eventually, right, Joe? I mean, there's such a disconnect in the market. And when
Yeah.
that happens, it doesn't matter if it's insurance or, grocery stores, right? Some entrepreneur is going to come in and figure out some solution and make a business out of it. So we're just waiting for somebody smart to come along and figure this out for us.
Are you bundling, or can you bundle all your portfolio under one policy?
Yeah, that's one thing we're looking at as well, is looking at just a kind of a blanket kind of
Yeah.
policy across the whole portfolio.
I have somebody. We have a vendor that's an insurance person. I'll give her your email and let her reach out.
Yeah,
She has a
yeah,
good
perfect.
program for that, and so that could be of help.
Oh, thank you.
Um,
Yeah, that'd be great.
yeah, try and help as much as I can because
Yeah,
these rates
that's
are.
yeah, we
I
got
mean,
to help each
I see
other
some
out,
of the
right?
numbers.
It's a,
It's painful. I mean, we had one building that we knew of here in San Fernando Valley that went from 3,000 to 16,000 a year,
yep,
and that hurts.
sure.
Because it's doesn't really adjust.
I've been hearing that all over the place. It's crazy.
Yeah. Yeah, with rates going up, they have to refi the building, insurance has gone
Hmm.
up. And
Hmm.
this is one that we were telling them, listen, this is really tight. I don't think you really want to acquire this. Well, now they're coming back, and if fortunately they can just
Yeah.
pay cash if they have to, but it was a
Yep.
bad investment. But um Tom, let me ask you, so let's say I've got 2 million to invest.
Hmm.
And I hear about Tom Dunkel of Belrose, and I'm like, I think this guy might be the guy I want to invest with.
Hmm.
Walk me through what I should be asking you for my $2 million. How do I know I'm going to get my 2 million, excuse me, 4 million now? Big investment. Now my 2 million back. I really want some big returns to get up to 4 million, but how am I going to get my
Right.
2 million back? What
Yeah,
should I be
sure.
asking you? What should I be looking for?
Sure, yeah. So, we as I mentioned earlier, you got to look at the sponsor, right? So you need to be looking at me and my background and my track record, but then also our team, right? So, another pitfall I see a lot of investors fall into is they get an email from, so and so at gmail.com, pitching a deal. Well, that's kind of odd, right? I mean, anybody who's a legit, sponsor out there is going to have a team behind them. They're going to have a company, right? So, I'm Tom at belroseam.com. So we have a whole team here that's looking out for deals. In fact, for every deal that we do, Joe, we probably kick, 40 or 50 or 60 to the side because they just don't work with our model. So I think what investors should be asking me is, about our acquisition process, about our due diligence process. What are we looking for? What are we screening for? And then once we do acquire the asset, what is our strategy? What technology are we using? How are we going to increase the value of this facility? So we have detailed plans that go with all of that. And ultimately, as we talked about early on, we're in capital preservation mode right now, but we certainly don't want people sitting on the sidelines in cash, because that's actually decreasing their buying power
Yep.
because of inflation. So, we want people to put their money to work intelligently in hard assets that are generating cash flow and tax advantages. So, I welcome questions about, me, our team, our process, our track
Mhm.
record, of course, is,
Yeah,
is another
historical
huge
is what I
one.
was going to say. That's key
Yeah,
too.
track record's another huge
Mhm.
one.
Yep.
And then, what we're seeing in the marketplace and how we mitigate risk, right? Because there's risk in any investment, right? There's risk in not investing.
Yeah.
There's risk in investing. So you just need to understand and ask a lot of questions about what we should or should not be doing. And again, that goes back to our ebook. It's really just a list of questions that should be asked. Certainly not exhaustive, but enough to get, the mind going in the right direction about what you should be asking.
Okay. If you can send me that ebook, Tom, I'll
Mhm.
just link, or send me the link to it. I'll link it down below. And then
Yes,
that way
sir.
people can go see it. They can find you and they can reach
Yep.
out and ask questions. But,
Perfect.
you know, thank you, Tom. I mean, I think there's some great information for everybody. And, I just think that we got to be careful. I mean, I've seen it happen to a lot of high net worth people that, they really tended to trust. And, so get out there and do your due diligence, reach out to people like Tom, and, they'll answer your questions for you. So, Tom, thank you very much for
That's
coming
right.
on today.
Thank you, Joe. This has been great, buddy. I appreciate it very much.
You betcha. And for those of you watching, if you could, please give us a like. And if you haven't done so, make sure you subscribe.